To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Hello friends, my name is Sriram and I am your faculty for Paper 2 Strategic Financial Management SFM. X Limited is interested in expanding its operation and is planning to install manufacturing plant at US. Okay. For the proposed project, it requires a fund of $10 million. Net of issue expenses and flotation costs. So, the net money that they need is 10 million. The estimated flotation cost is 2%. Right? 2% is the cost of the issue. To finance this project, it proposes to issue GDRs, that is Global Depository Receipt. You as a financial consultant are required to compute the number of GDRs to be issued and the cost of the GDR with the help of the following additional information. Expected market price of share at the time of issue of GDR is 250 rupees, face value is 100. Two shares shall underlie each GDR and shall be priced at 10% discount to the market price. Expected exchange rate is 60 rupees per dollar. Dividend expected to be paid is 20% with growth rate of 12%. Why did they give dividend? Why did they give growth rate? What is it that they want us to do? You are required to compute the number of GDRs to be issued and the cost of GDR with the help of following information. Why is this required? What is this number of GDRs to be issued and cost of GDR? What is cost of GDR? So, the cost of GDR is very similar to cost of equity. Okay, we have to find out, assuming that for every 2 shares you get a GDR, what will be the cost of GDR? We have to find that out. Right, and the number of GDRs, of course, it's a very simple thing. You need some money, each GDR is worth so much, so how many GDRs are required? Of course, I told it very simply, you have to do some working, right? So, let us have a look at it. How do we solve this? First what they said, expected price of share at the time of GDR, right? Solution. Market price, share, rupees 250, right? Then 2 shares and underlie each GDR. So, GDR equivalent market price of equity shares is equal to 250 into 2, that is equal to 500. Okay. Then 2 shares shall underlie each GDR and shall be priced at 10% discount to the market price. So, GDR price is equal to 10% of equivalent shares market price, that is 500 rupees into 90%, that is rupees 450. Okay, very simple. Then expected exchange rate is 60. Okay. Expected exchange rate is 60 rupees per dollar. So, dollar price per GDR is equal to rupees 450 divided by rupees 60 per dollar. So, that is equal to, so 6 goes 7.5 times in 42. So, it is $7.5, right? Price per GDR. Okay. This also we have got very simple. Now, what have they said here? For the proposed issue, it requires total funds of 10 million, but there are flotation costs of 2%. So, funds required is equal to $10 million. Flotation cost is equal to 2%. Flotation cost is equal to 2%. So, issue size is equal to 10 million by 98%, So, if you just compute this, right, 10 million by 98, 10 divided by 0.98, you will get 10.200408. So, 10.20408 out of this into 2%, you will get 0.20408. If you subtract, you will get 10, right. That is why we are doing by 98% or 0.98. So, 10 divided by 0.98 is equal to issue sizes dollars 10.20408 million, right. So, the total issue size is this much and per GDR price is equal to $7.5, correct. So, this implies total GDR issued is equal to 10.20408 million dollars divided by $7.5. So, if you divide this by this, So if you divide 10.2048 million divide by $7.5, you will get 1,360,544.2. So we will not have GDRs in decimal. So you'll have this many GDRs, right? 544, 1360. This is not 1360. 544 GDRs. This many GDRs are issued, right? This is the issue size. Is that what they asked? What did they ask? Your financial unit required to compute the number of GDRs. So we've computed, issued, and cost of GDR, right? We'll come to cost of GDR. But please note, you are issuing each GDR at 7.5, right? So how much money will you get? Money raised per GDR is equal to $7.5 into 60 rupees per dollar, that is 450. This is money raised, but money received is 98%, right, per GDR. So if on total 98% is received, so then per GDR also 98% is received. That is equal to 450 into 0.98. That comes to how much? Is rupees 441. Okay, this is the next point. Then what did they ask? They said, what is the cost of GDR? What is cost of GDR? P is equal to D1 by KE minus G. If you remember, this is the formula, right? What is the price? Here it is 441 is what you receive. So here you can make an assumption that this is the price or this is the price, right? So whatever the money which the company is receiving net of the flotation proceeds, you can consider this as the price. But let's say GDR is issued and it is listed, then the price is only this much. No? So you can take either assumption. Let us compute based on case A, where P is 441, that is net proceeds. P is 450, that is gross proceeds. Right, that is why I computed this 441, otherwise this was not required, right? So what is P? P is equal to D1 by KE minus G, right? So what is D1? Dividend is 20% with growth rate of dividend expected to be paid. So this is directly expected future. We can actually take this as 20%, 20% of the face value. Face value, right? Face value is how much? Face value is 100 per share. But then how many shares are there in a GDR? 2 shares are there in a GDR, right? So D1 is equal to face value per share into number of shares per GDR into 20%, right? So this will be 100 into number of shares per GDR is how much? 2 into 20%. 200 into 20% is how much? 40 rupees, right? This is D1. Then G is equal to how much? Growth rate. Growth rate is 12%. So P0 is equal to D1 by KE minus G, which is, so P0 is D1 by KE minus G. You can alternatively also do this as KE minus G is equal to D1 by P0, or KE is equal to D1 by P0 plus G. So either ways it is okay. I mean, I'm more comfortable with this whichever you use this, but if you were to simplify this particular expression, you can directly get KE. KE as D1 by P0 plus K plus G, right? So in our question, what is the KE? KE is what we have to find out. What is D1? D1 here G is 12% and they have given D1. D1 is 40 we have computed. So KE is equal to 40 divided by, which case is this? This is the case where it is 441, right? By 441 plus 12%. So what you will get is 40 by 441, which is 9.07% plus 0.12. So you will get it as 21.07%. Right. However, if you were to choose this other method, which is 450 as the price, because that is the price at which it will trade, then KE is equal to 40 by 450 plus 12%. So this will come to 445, which will come to 0.889. So plus 0.12, you will get 20.88%. Right. If listed price is considered, then the cost is 20.88%. If the net proceeds are considered, then cost is 21.07%. Okay, this is the way you have to solve. If you look at the material, they have gone by this method, which is net proceeds. But one reason why I think this is not valid is if you look at the question also, right? What did they say in the question? X Limited is interested in expanding so and so. For this, they proposed this much. The estimated flotation cost is this much. To finance it, this is so much. Are required to compute the number of GDRs, market price of shares, and shall be priced at 10% discount to the market price. So, basically that if they are listed, right, if you are going to list them, they will be only a 10% discount. You also should not remove the extra 2% which is the flotation cost, right. So, flotation cost need not be considered, but I think the institute has also considered flotation cost and looked at the net price, which is why they have got this higher rate of 21.07%. Okay. So, if you put both of them, one is gross, one is then it should ideally solve your problem. Okay, fair enough. Let us move to the next problem. So, friends, now let us look at the next question. The management of a multinational company TL Limited is engaged in construction of an infrastructure project. Okay, the proposal to construct a toll road in Nepal is under consideration of the management. The following information is available. The initial investment will be in purchase of equipment costing $250 lakhs. The economic life of the equipment is 10 years. The depreciation of the equipment will be charged on straight line basis. EBITDA to be collected from the toll road projected to be 33 lakhs per annum for a period of 20 years. Oh, so this is a 20-year project. 33 lakhs per annum. Everything is in USD, and they have given a lot of stuff in USD even though they are saying Nepal. Okay. To encourage investment, Nepalese government is offering a 15-year term loan of USD 150 lakhs at an interest rate of 6% per annum. Okay. The interest is to be paid annually and the loan will be repaid at the end of the 15-year in one tranche. Very good. The required rate of return to the project under all equity financing is 12% per annum. Oh, all equity. Here they have said about debt. Here they are saying equity. Okay. Post-tax cost of debt is 5.6% per annum and the corporate tax rate is 30%. Here they have said the interest rate is 6%, but here they are saying that the post-tax cost of debt is 5.6. Okay, they have mentioned two things. Which one is to be done? What we'll see. Post-tax cost of debt is 5.6 per annum. Corporate tax rate is 30%. Okay. All cash flows will be in USD. Oh, so it's a which company? Multinational company TL Limited. I don't know whether it is based out of India or which country, but they're saying they want to invest in Nepal and they're saying all cash flows will be in USD. Ignore inflation. Okay. You are required to advise the management on the viability of the project by using adjusted Npv method. So here they have said adjusted Npv method. What is adjusted Npv method? If you remember, we studied in this chapter only. Adjusted Npv is basically present value of the operating cash flows, which you basically arrive at by discounting the cash flows with cost of equity, and then present value of the interest tax shields, basically the tax benefit that we are going to get because of payment of interest, and you compute that present value at the post-tax cost of debt, and then what else? You discount those interest tax shields by using the discount rate of post-tax cost of debt, and then you also have interest subsidies if any subsidies. And is there anything else that is given? Yes, they have given present value interest factor at annuity for 12% for 10 years is 5.65. Then for 12% at 20 years is 7.469, then 8% for 15 years is 8.559 and 8% for 15 years is 0.315. Okay, what is the use of this 8%? What is the use of this 12%? See, 12% is equity, that is very, very clear. What is this 8%? 8% into 30%, 30% is the tax rate. Right. So, 8 into 30% is 2.4. So, 8 minus 2.4 is 5.6. So, that is why probably they have given this out. Anyway, let us proceed with this. Let us see how we are going to use this particular information that is provided to arrive at the adjusted net present value. Okay. So, let us start off with the question. Let us start off with the solution, and then we will figure out things. There are only two things that we have to be bothered about. One is this post-tax cost of debt is given, and they have given a present value factor for 8%. Okay, so we have to just take that into account. How we will adjust for that, we'll have to see. Okay, chalo, let's move forward. So friends, let's start off on this particular solution. Now, see, adjusted present value or adjusted net present value, it is primarily composed of three components. The value of operating cash flows, which is equity, which is basically you discount them by equity rate or the cost of equity. Then you have your interest tax shield, basically the saving on tax due to interest payment, that you discounted by the pre-tax cost of debt. Please do not forget that it is pre-tax cost of debt. Then you also have the interest subsidies, if any, that also you discount by pre-tax cost of debt, right? Now there are three components, and here in our case it is a what? It's a 20-year project, and loan is for 15 years. So, we should compute the cost operating cash flows, we should compute them separately. Your interest tax shield you should compute separately, right. So, this actually is also a question, I think if I am not wrong, from November 20 question paper. If you look at the solution, they have given two kinds of solution, one where they have considered the entire benefit because of debt, and one where they have considered benefit only of interest tax shields, right. So, if you look at our material is very specific, and even if you look outside of the material, adjusted present value is primarily the tax shield benefit due to interest, right. So, we will consider that. According to me, that is more appropriate than trying to take the entire cost of or entire benefit that is arising because of debt, right. So, let us start off on the solution, right. So, first we will say, we will compute first the equity portion or operating cash flows, operating cash flow, then I will say here years or particulars, particulars, years, okay. So, first what have they said? They have said initial investment in purchase of equipment is 250 lakhs. So, that is an outflow. So, you will subtract it towards the end. What is the inflow? The economic life of the equipment is 10 years. So, the economic life of equipment is 10 years is required for what? It is required for your depreciation purpose, right. So, that is required. Then the EBITDA to be collected. So, directly they have given EBITDA, right. So, EBITDA, and I will say USD million is how much? I will put it here. EBITDA for years 1 to 20, right, 1 to 20 is how much per year? 33 million, right. For 20 years it is 33 million. If you take present value factor, and these mind you have to be discounted at cost of equity, right. Cost of equity, let me call it KE, is what is the cost of equity? They have given cost of equity as under all equity financing is 12%, right. So, 12%. So, PVIFA, they have given PVIFA for periods or years 1 to 20, right, for all them cumulative is 7.469 for 20 years, 7.469, right. So, present value of cash flow, right, is for all these periods is 33 into 7.469. So, you get 246.477. I will put this as USD million so that there is no doubt. Okay, this is EBITDA. Then you have less depreciation. What is depreciation? This is for how many years? This is only for 1 to 10 years. That is why they have given the present value interest factor annuity for 10 years also. So, 1 to 10. How much is the depreciation? Total purchase of equipment is 250 lakhs, right. So, is it million or lakhs? See, I made a mistake, USD lakhs, that is what I was worried about, lakhs, right. So, here the cost of equipment is 250 lakhs, it is depreciated over 10 years. So, every year the depreciation is 25 lakhs. So, every year the depreciation is 25 lakhs, and that also you will discount at same cost of equity, and present value interest factor for period for 10 years for at 12% is 5.65, is 5.650. So, what is the present value of the entire depreciation? You will get 141.25. So, let me just copy this format. Okay, so 141.25, depreciation is subtraction, then you get PBT, of 105.2270. Then you can directly take tax at the rate of 30% because the tax is not changing. You need not again compute present value, future value and all of that for those. So, friends, after computing PBT, we can directly compute tax. See, one way to do this is compute the tax benefit that is arising on depreciation independently and add it back to post-tax EBITDA, and then look at the cash flow after tax. That is one way. This according to me is a much simpler way. I mean, we need not complicate our life, right. So, minus 30% into 105.227, you will get tax is this much, and PAT is how much? You add, or rather you subtract the tax from PBT, you will get PAT, then you add back depreciation. So, how much was depreciation? 141.25. So, cash flow after tax is how much? Is summation of PAT and your depreciation. So, 214.9089. So, let me highlight that. Okay. So, CFAT is this much, right. Then you initial investment less initial investment is how much? 250 lakhs, right? Yeah, minus 250. So, NPV from ops is how much? It's a negative number. Oh, is minus 35.0911. Okay, so NPV from operating cash flow is this much, 35.0911. Next, coming to after operating cash flow, we said tax shield on interest. What is tax shield on interest? Basically, whatever is the interest outgo on that, how much is the tax saving that you are making, right? Now, in our case, the loan is a 15-year loan and interest is paid yearly and the principal is repaid at the end, right? So, loan is how much? Loan is 150 lakhs. Okay, let me call this, use the same heading, and here it will not be cost of equity, it will be cost of debt. Okay. So, loan for years 1 to 15 is 150 lakhs. Okay. Then interest. This is also years 1 to 15. Loan is taken initially, right? So, which is why I put it as 150 lakhs, okay, inflow. I am not taking the repayment of the loan. We'll see. I don't think that is even required, right? So, what have they given as the interest payment? See here, one thing you should note, friends, the after-tax cost of interest, what they've given as 5.6%, pre-tax works to 8%, right? That number is to be utilized only for discounting, right? That is not the interest that you are actually paying on this entire loan. Right, the interest that you are paying on this loan, they have specifically said is 6% per annum. So, here the cost of debt here is 6%. So, you will actually use two rates, 6% for computing the interest, but 8% for discounting. It looks slightly weird, but unfortunately that is what it is. So, what is the interest on 150 lakhs into 6% is how much? You will pay every year 9 lakhs of interest. And what is the present value interest factor till annuity for at 8% for 15 years? Is 8.559. So, here what you will say is at 8% cost of debt for loan, for interest payment. Okay, this is 6%, but present value interest factor is computed at 8%. So, what is the present value interest factor at 8%? 8.559. 8.559. Okay. And or how did we get 8%? Just I explained it when I was actually reading out the problem, working for debt discount rate. How is it? Post tax rate is how much? 5.6%. Tax rate is 30%. Then pre-tax rate is 5.6 divided by 1 minus 30%. So, you will get 8%. That is how we got 8% present value interest factor. That is what should be used for computing the interest, total value of interest, that actually present value of interest that is paid over the 15 years. So, what is the interest present value? 9 into 8.5590. Now, what is the tax on this? Tax on interest paid is how much? 30%. So, here also you can directly compute 30 into 77 point whatever number we got, 77.0310, right? This is the tax saving on interest. It's called tax shield on interest. So, this is, you can directly take this as tax saving due to payment of interest, right? So, 23.1093. So, we can say NPV tax shield on interest is same value and right. So, now come to what is the total? APV based evaluation. Present value of operating cash flow, then present value of tax shield, right? Both of them we've got minus 35 and plus 23. So, net APV, net adjusted present value is summation of these two, which is minus 11.9818. So, let me highlight this. So, friends, this is net adjusted present value if you consider only the value of the tax shield on interest payments. However, if you remember when I was explaining, I told you that the material is given or rather the suggested answer is given the second method also, which is basically where you also consider the value of subsidy. Now, but though the solution doesn't talk about it in subsidy form, if you go back and look at the formulae, what I've explained to you, adjusted present value is summation of three things: your base NPV, operating NPV, plus your tax shield on interest, and I said there is no subsidy element in this particular problem. However, if you look closely into this problem, you will figure that the pre-tax cost of debt is 8%, but the government of Nepal, who's very keen on this project, is ensuring that they get a loan at 6%. So that 2% is subsidy, right? Right. So you can consider that 2% as subsidy, even though they have not specified that in the question. It is one thing that you can actually infer from the question, right? Though the material solution does not specifically talk of that, I think actually we should also look at that particular aspect, right? PV of interest subsidy, right? What is market interest? Is 8%, correct? Then you have interest on current loan is 6%. So basically they have got a loan cheaper. So interest subsidy is how much? 8 minus 6, which is 2%, right? So this 2% is interest subsidy on how much? Loan value in USD lakhs, right, is 150. So interest subsidy per annum is how much? 150 lakhs into 2%, which comes to roughly, you have 3 lakhs as the interest subsidy, right? Now this 3 lakhs, you should, and this is pre-tax, I have not taken any tax impact on this. So they have not, I have specifically not taken any tax impact on this. This interest subsidy, if you look at the formula, what we discussed and what I explained, the pre-tax value of the interest subsidy should also be discounted by the pre-tax discount rate, which is basically this 8% what we have, right? So this is over how many period? What period? Years 1 to 15, correct? So present value interest factor annuity for this is same as what we used earlier, which is 8.5590, 8.5590. Right, this is the present value interest factor. So, what is the present value of cash flow? 3 into 8.559, you will get 25.667. So, if you were to actually look at this, right, then adjusted present value, base, tax shield on interest, subsidy, present value, you take all these three. So base is how much? We've got minus 35.09. Tax shield on interest is 23.1093, and on subsidy, the present value of entire subsidy is 25.6770. So if you actually look at this, right, you sum up the tax shield on interest and subsidy present value, you will get 48.79. So if you look at the material answer also, the second option, or rather the first option what they have given is 48.828. Basically they have rounded off the decimal values, which is why I got a slightly higher number. So the benefit from the entire financing, they have taken it as 48.82, which is roughly approximately equal to this 48.79, right? So that is how they have actually considered it. Right, so you basically took a loan, then repaid the loan, you have this tax saving on interest, so on and so forth, right? So if you look at the combined APV, right here, what is the combined APV? 13.6952, okay. So what you can say is, if interest subsidy is also considered, then the project can be undertaken as APV is positive. Okay. So if you look at this, on the face of it, they have not asked for computation of interest subsidy and all of that. So ideally this answer should be okay, but if you are able to figure that there is an interest subsidy and for that we have to compute the value, then I think if you are able to compute this is brilliant. There is nothing beyond this. So I think you can go ahead with this. So the suggested answer solution is not really easily understandable. So I have tried and explained this to you by splitting the APV into 3 parts and computing the value of the subsidy also. So here, what are the key points to note in this question, friends? First, the tax shield on interest is always on the actual interest paid. However, the discounting of the tax shield is always done at the cost of debt, and cost of debt here is always is pre-tax cost of debt, it is not post-tax cost of debt. Then the interest subsidy, whatever is there also you take pre-tax interest subsidy and discount that at pre-tax cost of debt. Right. So, if you do that, you will basically get the values for all three elements, which are your operating cash flow separately, operating or base NPV separately, then you will get tax shield on interest separately, and the benefit of your subsidies separately. All these three, if you combine, you will get the net NPV, and then you can take a decision whether you should undertake the project, yes or not. Okay, fair enough. Let us move to the next problem. So friends, now let us look at the next question. This is a question from December 21 new syllabus paper. A US company wants to set up a manufacturing plant in India which requires an initial outlay of rupees 8 million. It is expected to have a useful life of 5 years and a salvage value of 2 million. The company follows straight line method of depreciation, and to support additional level of activity, additional investment in terms of working capital would be required is 1 million. So you have 8 million initial outlay, 2 million salvage value, so 6 million is the depreciable value of over 5 years, so 6 by 5 is 1.2. And then additional investment in working capital is 1 million. So initial outflow is 8 and 1. Since the cost of production is lower in India, the variable cost of production will be 30 per unit. Additional fixed cost per annum is estimated at rupees 0.5 million. The company is projecting its annual sales to be 80,000 units at the price of rupees 100 per unit. Applicable tax rate in the company is 34% and cost of capital is 8%. Inflation rate in US and India are expected to be 8%, 9% respectively. The current exchange rate is 72 rupees per dollar. Assuming that all profit will be repatriated every year and there will be no withholding tax, estimate the net present value of the proposed project in India and evaluate its feasibility. They have said present value factor at 8% for the first 5 years as under. So they have given the 8% as the rate at which you have to discount. For that they have given present value factor. So they have given cost of capital also as 8%. So that is what will be used at. And inflation rates, and they have given exchange rate so that you can figure out what is the exchange rate at which the remittance will happen or how many dollars will be required. Right. What is the investment? They have said, assuming no profit, estimate the net present value of the proposed project in India and evaluate its feasibility. So initially, whatever expenditure is being incurred, that is in rupee terms. We will convert that into dollars and keep that separately. And then separately, we will compute the cash flows every year, and those cash flows we will convert it into dollar terms. And then we will compute the NPV by subtracting the present value of all the cash flows from this particular business and the investment made. Net of those two will be the NPV, and based on that, we will decide whether it is a positive or negative project, whether it is viable or not. Very, very simple problem. Let us go ahead and solve this. Okay friends, so let's start off. A US company wants to set up a manufacturing unit. So we have a standard methodology, which is first compute depreciation so that you can compute the cash flows. But before you compute the depreciation, you also have to compute the exchange rate. So first thing, exchange rate. Exchange rate. USD, INR. Then inflation rate India. Inflation rate US. Okay, current exchange rate is 72. Inflation rate in India is how much? In US and India are 8%, 9%. India is high, so 9%, and US is 8%. Right. So what will happen? Because the inflation rate in India is higher at 9%. Yes, the rupee will depreciate. So by how much? 72 into domestic. 1 plus 9% divided by 1 plus 8%, right? You will get 72.67, and these rates are going to remain like this for next 5 years. That is what they said. Inflation are expected to be so and so, current exchange rate so and so. They have not mentioned anything about how long this will continue, and why are we doing this for 5 years? Because the project value is 5 years, so life is 5 years, so we are doing this for 5 years. So for every year you compute the exchange rate like this. Let me change the spelling. Exchange rate. Okay, inflation rate US is this and exchange rate is this. So first we have arrived at exchange rate. Then plant cost is INR million is 8, and then salvage value is 2. So depreciable value is 8 minus 2, which is 6. All of these are INR million. They have given million only, right? Yeah, INR million only. Okay, then useful life is years, right? 5. Then depreciation per annum is 6 by 5. It will be depreciation per annum is 1.2. Then we have computed these two. Now we can get ahead and start working on the profitability statement and free cash flow, or what is CFAT, right? So units sold per annum, PA. How much they have given? 80,000 at a price of 100 rupees per unit. Now will these prices also change? So here unit sold is 80,000. Okay, so let me assume that all these are going to be like this, right? So if unit sold is very clear, there is no change in unit sold. The prices, the price at initial sale price is 100. Sale price initially is 100. So if inflation is going to grow at 9% in India, do you think that the price also should grow? If you remember, we did a problem where we exactly did this. So sale price adjusted for inflation. You have to do this for costs also. 100 into 1 plus India inflation rate, which is 9%, right? So you will get 109, 119, 130, 141 and 154. Let me put them in 2 decimals. Right, then what else? The variable cost would be 30 per unit and fixed cost is 5 million. Variable cost, again adjusted for inflation, and I will say rupees. Okay, this is how much? 30, right? If it is first year 30, then this will get adjusted for inflation, where you keep increasing it by 9% every year. They have said 8 and 9% inflation rates only. They are not anything else. They are not said their interest rates or anything like that. So you will have costs of this much every year. You will have this much cost. So contribution per unit in rupee terms is how much? You have to subtract these two, the sales price minus the variable cost, right? So you will basically get this as a contribution. Then total contribution in rupees million, right? Everywhere they have given million. So let me take rupees million is 76.3 into 18,000 divided by 1, 2, 3, 4, 5, 6 by 6 zeros. So you will basically get 6.1 million as the total contribution in rupees million, right? So for that was the first year. For the last year, you will get 8.62 million. Then fixed cost in rupees million. What is the first year fixed cost? 0.5 million, 0.50. Okay, so for the second year, again this will also grow by 9%. And so if you were to compute this fixed cost growth over the next 5 years, you will get 0.77 for the last year. So after contribution and fixed cost, then you will get, is there any interest, no jamela of interest, right? So you can directly take PBT. PBT rupees million is how much? Difference between contribution and fixed cost, right? Which is 5.56 for the first year and it is 7.85 million for the last year, right? So then tax at the rate of 34, right? They mentioned 34% and there are no withholding tax also at 34% is equal to or minus 34% into 5.56, 1.89, and last year it will be minus 2.67. So PAT is how much? Is there a depreciation? Oh, see, I forgot depreciation, which is why you should be careful. You should be definitely careful. You should not make this mistake. Depreciation. I made a mistake there. We shouldn't make this mistake. What is the depreciation? We very specifically computed. So depreciation of minus 1.2. Right. So every year there will be depreciation of minus 1.2. So the PBT will be to contribution minus fixed cost and the depreciation, which comes to 4.36. See, you shouldn't make this mistake in a hurry. I missed it. You should not miss it. Please do not miss it. Then on that you compute tax. Tax of 1.48 for the first year and so on and so forth, minus 2.26 for the last year. So PAT is 4.36 plus the tax, whatever you get for the first year you get 2.88 as the PAT, and for the last year you get a PAT of 4.39. Now on salvage value, is there any depreciation or anything like that? There is no capital gain, right? So the concept of the book value is also same. The income tax book value is also 2 lakhs, and this is the sale price also 2 lakhs, and hence we will assume that there is no taxability on the asset that is sold. So right, so we've got PAT. We should make simplistic assumptions when information is not fully available. You should not complicate life. Okay, so PAT, from PAT then add depreciation, from PAT add depreciation. How much is the depreciation? 1.2, right? So if you add depreciation, you will get CFAT or FCF, you can call it FCF or CFAT. No, we'll call it CFAT, we'll call it FCF after we make the adjustments for investment value, okay? Right, so you get CFAT of 4.08 for the first year and 5.59 for the last year. All this is in rupees million, okay? So you've got CFAT of this much. What is the specific thing you are being asked? You are being asked, assuming all PAT profits will be repatriated every year, no withholding, estimate the net present value of the project in India and evaluate net present value of the proposed project in India and evaluate its feasibility. Okay. So what we will do this is, these cash flows we will first do, convert them into dollar terms, right? Cash flow in US dollar million, right? So you get 4.08 divided by 72.67. So we will multiply with million so that you actually get a number that is reasonable. So you get 56,105 for the first year, so on and so forth. You do this for all the years, you will get it in dollar terms, right? You are dividing the rupee cash flow after tax, you are converting it into dollar, right? Present value factor they have given for 5 years. What is it? 8%, right? At 8%. So it will be 0.926, then 0.857, then 0.794, then 0.735, then 0.681. Okay, so present value of cash flows is multiplication of the cash flow in USD with the present value factor, right? Okay, so you basically will get the cash flows, present value of all the cash flows. So present value of cash flows sum is all 51,000 in approximately into 5 is what it is coming. So it will be something about 2,55,000 US dollars. Okay, so this is the present value of cash flows, all cash inflows, you can call it present value of cash inflows, right? This is the present value of all the cash inflows. Now this is one aspect. What is the other aspect that we are supposed to do after computing present value of cash inflows from operations? That also I will specify from ops. Okay, why am I saying ops? Because you have two more things, which is, first is to support additional level of investment, there will be additional working capital. There is initially an investment of 8 million investment. I will give everything in rupee million. First year is -8. Then you also have working capital rupee million. You will have this investment of -1, correct? They said that additional work would require one-time additional working capital investment of 1 million. Then you have investment, you are recouping 2 million after 5 years because you are able to salvage the particular project, whatever the salvage value of that particular manufacturing plant is 2 million, and you will also get back this 1 million what you have initially invested in working capital. So you actually have to take investing cash flows, you have to take a sum of these also, right? You will do this for all 5 years. Then you will convert them in to dollar million from rupees million. So here I will put rupees million, investing cash flow dollar, and I will not give million here also. I think I will remove the word million, alphabet million in USD. In dollar. So -9 into 1, 2, 3, 4, 5, 6 divided by whatever is the exchange rate, 72, right? So you will get 1,25,000 is the initial investment. After that, the last recoupment what you will have is 39,790, right? This you can compute present value factor, PVF at 8%. See, you can compute present value first and then discount, or you can do this way. Either ways, it does not matter. We have been doing dollar first and then present value, so that is what we will continue, right? So for the first year, the present value will be 1. For the second period, or rather for 0 period it will be 1, for the second period it will be beginning of the project it will be 1, at the end of first year of the project it will be 0.926 and then 0.857, 794, 735 and 681, what we have already been given in the question. Then present value of investing cash flow is you multiply the dollar value into the present value factor. So, you will get minus 1,25,000 for the first year and in the last year you will get 27,087. So, if you do present value of investing cash flow, this is US dollar. You will basically, if you were to sum this up, you will get 97,903 negative, right. So, present value of cash flow from operations is 255,815, which is positive, and from the from investment activity, whatever you are making investment and including the working capital what you are investing, which you will recoup after 5 years, you will basically be making a present value, which is net present value of that is minus 97,903, or 97,903 is the net present value, which is negative value. So, NPV of the project is 255,815. If you want, actually I will put this 255,815 also in 0th period so that there is no confusion. Present value of cash flow from ops and present value of investment cash flow in US dollars is also US dollars, right. This will be minus 97,903. So, if you sum both of them, NPV of the project will be summation of these two, which is 255 minus 97. So, the net value is 157,912. Okay. So, this is the answer for this question. And what will you say? Project is viable as NPV is positive. Okay. That is the answer to this particular question. Fair enough? I will give you enough tools to help you understand a lot of stuff. If you were to revise it frequently, you will remember the key points. We will give you some mnemonics. We will give you some ways to remember, but there is no need to mug up. I believe that we both together can work on all these three things: concepts, practical application and examination.